welcome to the FII View with me, Tanveer Gill. My guest today on the show is Masha, Head of Emerging Market Equities at PIMCO. Masha joins me all the way from London to discuss her view on India and emerging markets. Masha, great to have you as always. Let me begin by getting your view on India first. With this win, a thumping majority that is, do you think that India is on course to implement the reforms that have been long pending and thereby start a new bull run? Given that the 5-year return, adjusted for the currency movement, has been really marginal and not so impressive for foreign institutional investors such as yourself. Does the victory mark the era of stronger positive returns from the market?
Well, look, clearly elections have enabled India to have a stronger government to implement reforms that we've been talking about so much, and the lack of which has brought around outcomes of negative returns last year. If you remember, the summer was a very, very nerve-wracking experience last year when you had currency sliding and effectively erasing some of the positive returns from prior periods. We've since had a strong repair on the back of RBI governor being very decisive and very, very good. And we hope that the same trajectory could be picked up from a strong government now coming into the office. Clearly, it's very early days. We haven't seen any program unveiled, and success will very much depend on those first sort of 100, 200 days when the program gets announced and then the market starts watching the implementation of the initial steps. But as far as enabling is concerned, we have a strong person at the helm of monetary policy, and now we have a government that has majority it hasn't had for a number of decades.
Masha, while you don't invest based on poll results, I know that you have been incrementally allocating to India since the last 6 months. Given, the kind of value that you've seen in the markets as well as on the currency front, will India continue to be a buy on dips market, you think?
I think India has a very good chance of becoming a secular bull market in EM. Given the outlook for relatively lackluster growth in emerging markets in the coming years because of the lack of the aggregate demand, there will be, in our view, a strong differentiation between countries that embrace supply-side reforms, which is hopefully India's case, and countries that continue to rely on the export growth cycle, which is unlikely to be a huge help or as much of a help as it was, say, 5 years ago. So hopefully India would be the case, the former case, and investors would come to the story with, again, hope and hopefully realized hopes of higher trend growth.
What about the rupee? Given that range of 58 to 60, do you think this is the range that the rupee will hold for the near term? Is this the fair value range, so to speak, for the currency?
Well, rupee clearly has been underpinned by a growing credibility of RBI. The governor has been independent, has put forward important enablers for the current account deficit closure. We've seen very competent work there that has brought strengthening of the rupee. And as hopefully Modi government moves away from fiscal imprudence and remove some of the benefit programs from the budget, again, hopefully over secular horizon, that would be positive for fixed income markets because, again, we will, combined with growth, that fiscal prudence would provide fiscal outcomes that will be supportive for the currency. So yes, if our views on the trajectory of this government get realized, rupee should be well supported.
Right, again, not talking about specific targets on the market because I know you'll stay away from, giving out one. Do you think that the Indian market will be a market of higher highs and higher lows going forward from here?
Look, much depends clearly on the delivery. We've had a nice run into the elections. The expectations are elevated. It's an important one. But so is the outcome. The outcome that was produced, does provide us with a hope that this will be a different decade ahead in India. But again, much depends on those initial days as market reads into the program and reads into interaction, importantly, of Modi with the state governors and the states, if we see that he is indeed capable of taking out that gridlock from the system that prevented infrastructure development, that has provided this very extensive pork barrel a trade-off that has again kept India's growth. If we see those removed, I think this will be a market of higher highs and higher lows.
Masha, it's interesting to see how sell-side analysts have been revising targets higher on the index. The targets averaging around 8,000 on the Nifty, 28,000, perhaps even 30,000 on the Sensex, roughly valuing the market at 18, 19 times FY15 earnings. What's your view on value-adjusted upside to the market, given your earnings expectation over the next 12 to 18 months?
Well, look, 2015 is a year where earnings are unlikely to be, or earnings growth is unlikely to be very high because we are, frankly, halfway through that year, right? It's March 2015. This is the year when aggregate demand, remains lackluster because of the cyclical slowdown that the economy has experienced. So again, I wouldn't be looking at PEs of 15 as a great indicator. So we would kind of need to start thinking about the earnings power over the next 18 months. And that is, again, very much dependent on the restart of infrastructure projects, on the effective conduct of monetary policy, because that would enable the bank's lending. So if we have stable rupee, if we have rates that peak and potentially start trending down, that would be a positive jolt to growth, and should be a positive upward trajectory for the earnings of 2016. So again, 15 is a bit of a write-off. In our view, 16 is the number one should focus on.
Masha, you have been buying private sector banks in India. You have some holdings there. With the new government, is the focus increasing on state-owned banks? Because we've seen a stellar rally in most of those names of late. And not just state-owned banks, but also state-owned companies. Do you think that there is more interest building in them on the expectation of new policies being put in place?
Well, that much depends on the privatization program of both banks and the state-owned companies. So these are clearly cheap assets. So if you look at the state banks, some trade at book or below book, but these were the companies with serious governance issues. Now, the white paper published by RBI is calling for a different governance models for the state banks. If that indeed gets implemented, if the ownership of the state gets lowered, and that's not the near-term case, we could see those franchises accelerate in their ability to print profitable growth. So I think that that's not necessarily a bad bet, but one has to get a bit more confidence around the resolve of Modi's government to carry on with what could be initially pretty unpopular measures.
Masha, also everybody keeps talking about the infrastructure needs in India. Which pocket of infrastructure do you think would draw most interest going forward? Because it's really broken down between power utilities, power distribution companies, road project companies, bought projects, engineering, construction companies, etc. Which is the segment in infrastructure that you like the most?
It's such a hodgepodge, right? Because we really need to look here at company specifics. Power could be okay, but it all depends on the ability of state electricity boards to remain solvent. So, and that again goes into this pork barrel trading that will be going on between the federal government and the states. Infra perhaps gives you more near-term upside, as we could start seeing visible movements in the book-to-build ratios of these companies. But again, it's very much dependent on the company specifics, because these are typically quite levered companies, and the near-term liquidity requirements remain substantial. So look at the bottom-up analysis and see whether indeed you have a life-changing event there.
Masha, what about the defensives then? Have you booked profits from IT, pharma and consumer names in India, which you liked till last year?
We do not hold any IT companies or pharma today, but we are looking with interest at, clearly a very strong derating that is happening in that space. These are strong franchises, quality companies. They're not looking as clear winners in this case because they've been clearly driven by the global demand. They are clearly beneficiaries of weak rupee, not strong rupee. But again, don't discount the likes of HCL, Infosys, and TCS because, again, these are companies with strong trend earnings power. We are focused on private sector banks. That's, we believed, was a strong bet on a favorable election outcome, but not an excessive bet. So in other words, you did not need to assume a very large auctioning program for new roads, say, to make the bank story work. And in addition, banks were supported and are supported by depressed cyclical environment. So any change from here should provide us with a nice long growth momentum. So again, that will remain our focus for the medium term. These banks are not excessively valued and remain very good conduits of conduits for the positive election outcome.
Also, Masha, what do you hope to hear from the government between now and the budget in its economic agenda, essentially? Top 3 expectations that you have as a foreign institutional investor.
So we will need to see 2 things. One is the enablers of growth. In other words, what infra spending, being built in, but then also we will need to see the signs of fiscal prudence and a sign of reining in some of the benefit schemes that were populated by Congress. So these 2 vectors should give us a sense on the sustainability of the budget, in the coming year, as well as inflation outlook. It'll very much inform that. So some pullback in the benefits would be positive for inflation. And ultimately, this will be a litmus test for the new government, to show their ability to break with the past, take some less popular measures in order to achieve desired medium-term outcome.
I keep asking this, but the concern is really on growth revival and managing inflation. What is your own expectation on that? What does that do for your expectations on rates as well going forward? What is it that you're penciling in on these 3 variables?
Look, the pickup in growth, provided the inflation remains benign, is a positive for growth because it helps resolve some of the deficit conundrum that resides in the budget. Clearly, if growth is driven by social spending and therefore we have negative inflation outcome at the end, that will require some adjustment on the monetary side and will be negative for rates. But as growth is concerned, again, if it is driven by transition towards a higher trend growth in India because of the secular adjustments, that is positive for rates medium term.
Masha, given the recent rally in the markets, actually the last 6 months, which have been fairly rewarding, 15% return coming in for the Indian market, outperforming the rest of the region. Could you share with us 1 or 2 company names that you have in your disclosed portfolio that you have entered into from a long-term perspective?
Sure. Well, on the private sector bank side, like Axis, we purchased the counter in the summer of last year when the expectations were indeed very depressed. It's a private sector bank. It has a stock of non-performing loans, though not excessive, that hopefully will provide it with some of the recovery earnings power. And it is a bank that is growing its books nicely. It has CASA franchise that is sufficient to continue funding that growth in the future. And the valuation, again, is well off the highs, though obviously not as cheap as it was last summer. The other one is a long-term story, and that's Tata Motors. We've held the company for the past 2 years, and that's a story of emerging global brands. So not India specific story as such, but given where the company trades valuation-wise, we still find significant upside on a 2 to 3 year view to the JLR franchise becoming larger in the global scope. So again, we would think that Tata does have strong earnings power that is yet to get recognized by the market.
Also, stepping back and looking at the whole EM picture right now, Masha, is it fair to say that India's profile is the best as an investment destination among emerging markets? Its debt to GDP is low versus other EMs. Deficits are down. Currency is done very well. All these factors are really working well in terms of drawing more interest from FIIs.
Well, it does stand out, and that's partly being reflected already in the market, right? Remember, rupee was one of the first currencies in the past 12 months to hold depreciating trend and to start the appreciating trend. And the market, is clearly looking for stories where there is a proactive government move towards market-friendly outcomes, because we have a number of EM countries that are still struggling with that notion. Look, for example, at Brazil, where there is a tug-of-war between the current government and the market, because there are expectations that there has to be change. But again, this is the expectations that are yet to get validated by the election outcome. So India does stand out because it has delivered on the monetary side, and the market hopes it will deliver now on the fiscal and growth side.
How do you compare investor interest to invest in EMs via ETFs versus mutual funds? For that is more long-term money. So do you think that there is a bit of a tilt that's happening there? We've seen a lot of the flows come in via the ETF route. Do you see the trend building where allocations on the active management side are also building? More money is coming in via the mutual fund route?
Well, look, ETFs typically lead the market. This is the crossover money coming in for quick implementation. And as the investors gain again traction, and as EM gains favor as a asset class destination of choice, people switch towards active managers and therefore switch towards stocks. So it is a sequencing issue rather than the pure preference issue.
I also wanted to ask you about your broad overall EM strategy, accounting for the risks in Ukraine, Russia, and China. Given those risks, how are you allocating capital? How are you positioning yourself within EMs?
Well, look, these are the countries that are experiencing, Russia and China, that are experiencing depressed growth. Clearly in China, we are dealing with the issue of deleveraging that needs to take place, and an issue of reform that has to take place in order to avoid the debt bubble, going forward. So China is in that transition, and that is a difficult transition to manage. Again, given the imbalances that have been created, given the amount of bad debt accumulated in the system. Now, it's clearly the country with very large sovereign resources that it can put to work, but it is still very much an exercise in juggling, given the resolve to remain on a trajectory of trend growth of 6 to 7%. Russia and Ukraine is a geopolitical issue of the year. It is, clearly an issue that will have negative impact on Russian growth. So there you have to focus on a combination of value, and Russia provides plenty of, with a strong dividend yield. So if you have near-term cash flows delivered to you in the form of dividends, you are more likely than not to realize that value offered by the market.
Also, give us a sense, since you speak to a lot of investors and fellow fund managers, what kind of money can come into emerging markets in the next 6 months? Because this has been an under-owned segment since almost 12 to 18 months, given the rally that we've seen in the US and, of course, last year in Europe as well. How much money is really waiting on the sidelines to get directed into emerging markets over the next 6 months, second half of this calendar year?
Well, look, in good years for EM, we had inflows of anywhere between $20 and $40 billion. So there, clearly could be a lot more coming in. We've only had the halting of the outflows. We still remain negative for the year. So what needs to happen, whether the catalyst for the asset allocators start favoring EM again after 3 years of exit. Clearly one is countries like India providing us with the hope that trend growth could pick up, and that is a compelling case then, given that the rest of the world, as we maintain, will struggle to reattain the growth rates seen 5-6 years ago. The other one, clearly is the break in the negative earnings trajectory that EM has had. So much of the negative relative performance in the past few years have been explained, but that continued lack of aggregate demand weighing in earnings and providing the negative earnings story, whereas the rest of the world has experienced some recovery. So any break from that can come from proactive, pro-market policy moves like what we're seeing in India, or better demand, or cost-cutting and some healing will reignite the confidence in the EM earnings cycle. But again, thus far, we are still struggling to show positive relative earnings growth relative to developed markets.
And finally, Masha, in talking about India specifically, how much can India get of this allocation to broader emerging markets? We've received about $10 billion so far into the year. India average allocation standing at 6% in global emerging market portfolios. How different could these numbers look 6 months down the line?
Well, India, kind of the neutral case is 6 to 7%, but again, given that it is a fairly larger rate in EM portfolios, that could be anything between, sort of 6 to 10 to 12%. And again, I think India will get marginal dollar provided Modi delivers in the first 100 days and manages to cement and consolidate that vote of confidence in the market-friendly outcomes.
Well, Masha, thanks very much for taking out the time to speak with us today. As always, really appreciate your insights on India and other emerging markets. With that, we come to the end of this edition of the FII View. Thanks very much for watching the show.